Welcome back. I'm Greg with the Ashcraft Firm, and I'm an estate planning attorney. And over the last couple of weeks, we've talked about 2 of the ways to pass property at time of death. And this week, we're going to talk about the 3rd way to pass property at time of death. So in week 1, we talked about estate and how if you do nothing, your property will pass through probate. And we talked about the pros and cons of that. And in week 2, we talked about passing property by contract, and we talked about the pros and cons of passing property that way. And then this week, we're going to be talking about the pros and cons of passing property through joint tenancy. So what do we actually mean when we're saying we're passing property by joint tenancy? So usually this phrase is actually used in deeds, and joint tenancy is shorthand for joint tenancy with right of survivorship. And this is the other way to hold property rather than tenants in common. So typically you either hold it sole and separate, you hold property just by yourself, or you hold property as tenants in common, or you hold property in joint tenancy. So if you're holding property with more than one person, you either have to hold it in joint tenancy or tenants in common. So if you hold the property as tenants in common, then that means that you just own a percentage of the property in the same way you would as separate property. Meaning, like let's say we hold the property 50-50 as tenants in common. So let's say my wife and I hold our property as tenants in common 50-50. If I have 50% of the property, and if I pass away, then that 50% of property that's held as tenants in common will pass through probate. Okay, so I hold that property. I can actually make agreements with people where when I pass away, I pass my tenant in common share to anyone. It doesn't have to go to somebody automatically who's on the deed. So I could write in a will, for instance, I could say my tenant in common share of my house that I hold jointly with my wife as tenants in common, that I give that property to my son or something like that. When you hold property in joint tenancy with right of survivorship, then you can actually, so if I hold property with my wife, like my house, if I hold that as joint tenants with my spouse, then when I pass away, it automatically passes to my spouse. And so those are some of the pros of this. If you pass property that way, it's automatic. Okay, so let's say we hold property as joint tenants, my wife and I, and then I pass away. All she has to do is file an affidavit of death of joint tenant with the county recorder where we held that real property, and then she automatically becomes the sole owner of that property. And this avoids probate. So those are some of the good parts of passing property in that way. But there are lots of downsides to passing property in that manner. So first, we can't really name a contingent beneficiary. So we can't say, unless we just keep adding people as joint tenants on our property. So let's say that after my spouse passes away, I want my children to inherit that property. The only way to make them contingent beneficiaries is really to add them onto the deed as joint tenants. So then we'd all own this property as joint tenants. Then we have lifetime problems. So the next downside of holding property this way is you're no longer in control. So let's say that we did want to name our children as contingent beneficiaries after my spouse and I pass away. And so we add them all onto the deed. Now we're no longer in control of our property. So now when we want to sell that property, we have to get them to sign off on the sale. Now, while you're you have your wits about you, or while you're still young, this may not be an issue to you because your kids are going to sign off on it, right? Like they're gonna consent to whatever kind of sale you have. But as you get older, your kids are going to think that they know what's best for you. And then you're losing that element of control that you have over that property. So that's one of the other downsides of holding property as joint tenants. If you are putting your kids on your deed or something like that, or if, let's say, you hold your bank account jointly. So this doesn't just have to do with deeds and real property. You can hold your bank accounts in joint tenancy as well. And if you do that, you're no longer in control. Let's say that your child who you've put on your bank account as a joint tenant now falls into financial problems. Let's say they started a business and the business failed and now they have creditors coming after them. Now they can come after your assets as well. Because you hold that property jointly, they can go after your property now too. So those are some of the issues that come with holding property as joint tenants. And then finally, one of the problems that you're trying to avoid is the cost and time associated with probate when you hold property this way. And so a lot of people actually, they don't hold property as joint tenants. I want to step back and address the issue of just deeding your property over to those people that you want to inherit the property anyway. Some people go that way instead of other methods of transferring property. So they don't wait till they pass away. They just give the property while they're living. That's essentially what you're doing when you hold property as joint tenants. You're giving a property right in that property while you're living. And so there are lots of tax consequences with either just deeding a property over outright or holding property as joint tenants. And I want to go over what some of those tax consequences are. And really I need to do that by drawing it out for you. All right, so I've drawn up here the tax consequences of joint tenancy or gifting property while you're still alive. So they're really the same tax consequences, so I wanted to talk to you about it together because a lot of people think that it's a good idea just to give away their property while they're living. Then they don't have to go through the whole process of probate and things like that. There are major tax consequences to passing your property that way or by holding property as joint tenants, and I want to show you what those are. Okay, so let's say, and this applies to any type of property that increases in value, but I'm showing you this house, okay? So let's say we purchased the house, in 1990 at $100,000. And let's say that increased to today, in 2017, let's say that increased to $300,000. So this $100,000 is our tax basis. So there are things you can do with your taxes that will make the tax basis either increase or shrink, but for the reasons of keeping everything simple, let's just say you didn't do any of those things. You didn't make it increase or decrease. So now your tax basis is $100,000. When this house increases $200,000 in value to $300,000, now if you sold the property, let's say you're not passing the property at all, but let's say you sold your own property. You're going to have to pay capital gains tax on all of this. And so that capital gains tax on the $200,000, it used to be that long-term capital gains tax was a simple 15% across the board. Now it can go up to 23.8%. This is federal. And then you can add at least another 9% on that for the state of California. So that's at least a quarter of this is going to be taxed, is going to be the tax that you pay. So if that's a quarter of $200,000, then we're talking about $50,000 here. Now, if you add your child onto your deed, now we have already talked about all the other downfalls of adding your child to your deed, but let's say you add your child onto your deed and they don't have any financial problems, they didn't hold it over you, while you were living. They let you sell property that you needed to and things like that. Let's say all of that was fine. Now you pass away, and when you pass, that property is worth $300,000. It hasn't gone up any. And now they turn around and sell it. They're going to be paying tax on this $200,000 as if it's increased. They're going to pay capital gains tax on that property. And this is true of any property. When they sell that, when they liquidate that property, they're going to be paying the tax on that. So it's going to cost them $50,000 plus in this scenario to pay the taxes on that. Now, let's talk about passing property at death. So let's look down here. So let's say instead of passing the property either during your lifetime or passing property through joint tenancy, let's say instead you pass property through a will or a trust. Now, it's still true that if you're selling property yourself, like you haven't passed away, we're in 2017 here, so you purchased the property in 1990 for $100,000, same facts as here, and then in the year 2017 it's worth $300,000, that's not outside the realm of possibility. That happens a lot, those types of increases. Now let's say that you sold that property, then you would be subjected to that tax on the $200,000 as if it's an increase. Now, you may be thinking, well, I've sold my primary residence before and I didn't pay a big load of capital gains tax. There are ways that the owner of a primary residence can avoid these types of taxes. So that's why you didn't pay the tax if it was your primary residence. Now, if it was a rental property or something like that, an investment property, you did pay taxes on that if you sold it. However, if you put your kids on your deed as joint tenants, or you gifted the property while you're alive, your kid is not the owner of this property and can't avoid these taxes. However, if you give in a will or trust and you pass away and they inherit that property, then they get what they call a step up in basis to the date of death. So the time that you passed away, let's say it was worth $300,000 still, and it didn't increase in value at all, and your kids turn around and sell it the next day, they pay, instead of $50,000 plus, they pay nothing in taxes, in capital gains tax. So it pays to pass your property through a will or trust. Here's the problem though. If you remember from week 1, a will goes through probate. But next week, we're going to talk about how a trust can avoid probate and avoid these negative tax ramifications. So let me just recap everything that we talked about earlier. The pros of joint tenancy are, 1, that it's automatic. As soon as somebody passes, the other joint tenant becomes the owner of that property. And because of that, 2, it avoids probate. Now, the downsides of holding property in joint tenancy are that you can't create any contingent beneficiaries, and if you keep adding on joint tenants, then you lose more and more control because they all have to consent over anything you do with that property. Now, 3rd, you've done all this joint tenancy maneuvering to avoid all the fees that are associated with probate oversight. However, you're probably going to end up paying more in taxes in the long run. So I hope you enjoyed watching this video, and if you're interested in hearing when the 4th and final video goes live, you can fill out your name and email address. There's going to be a pop-up that comes up after this video, and then we will tell you when that goes live. Thanks again for watching.